and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve, and here are some of the trends we're going to be diving right into. It was a tough day on Wall Street. President Trump heading to Davos and ramping up his tariff rhetoric, spooking investors around the world. The S&P 500 has wiped out gains for the year, and we're taking a closer look at what you should be watching. Plus, the AI boom is not the only trend in tech. Tech giants from NVIDIA to Tesla are making major investments in robotics. We have the CEO of one company that's expanding in the space straight ahead. And credit cards are in President Trump's policy crosshairs. Rewards programs could hang in the balance. We have a conversation with the CEO of Blikre Rewards. That's later this hour. Well, Serve Robotics is making a move beyond sidewalk food delivery, announcing an acquisition that pushes the company to hospitals and healthcare automation. Joining me now is Serve Robotics CEO Ali Kashani. Ali, it is good to see you. So let's start on this news, Ali. You're acquiring Diligent Robotics, so expanding, it sounds like, beyond sidewalk delivery into hospitals. Explain this move, Ali. Why is this the smart vertical for you guys to leverage?
Yeah, thanks for having me again, Josh. We're very excited about this. We've been talking about this in the past, if you recall, that we see ourselves as a platform for robots that can move among people. Now, sidewalks and delivery, it's a massive opportunity, and it was a really great place to build the technology, and we are going to continue growing. As you know, we went from 100 robots to 2,000 robots last year alone, so we're going to continue that. But we want to bring this to more places and opportunities to help more people. Diligent has been operating in hospitals. They're in more than 25 hospitals with 100 robots. I think they're at that inflection point, just like us, to grow really fast, and we can really support them through that growth with our technology, with our platform. And I think it also means that we are now going to be helping, again, more people in more places, such as nurses who, right now have to walk around grabbing supplies and medication, or they could actually be spending more time at bedtime of patients and using robots to do that kind of menial work.
The hospital, of course, it's obviously a very regulated, highly regulated arena and space. How do you sort of navigate that, Ali? The questions I would assume about safety and patient privacy and compliance.
Mm-hmm. Absolutely. Look, there's a lot of work that has been done by the Diligent team, and that's why, rather than us expanding into that by ourselves, we decided to go work with a team that has been doing that for years. They have a fleet at a commercial scale already who has actually tried to solve all this problem with HIPAA compliance, etc. So we can really just rely on their expertise so that we don't have to learn things from scratch.
What is the business model here, Ali? How would monetization, how would it sort of compare and contrast with food delivery? Is it a potentially, higher margin opportunity?
I believe it is, yes. So we've shared in the news that Diligent makes something in the order of $200,000 to $400,000 per hospital. Usually hospitals have a handful of robots, sometimes 2 or 3. So you can kind of do the math on what that amounts to. But it's a really much higher kind of growth opportunity than an infrastructure play, which is what our main business is, like last mile delivery. I think infrastructure is really, really big in terms of the addressable market, but it's lower margin, versus when you go into specific domains like this, you can often find things that may not be as big as the original TAM, but they have better margins and better profitability opportunities.
I'm sure some of your investors, Ali, might be thinking, is this a one-off acquisition from Ali, or no, more M&A to come? How do you answer that?
Well, this is a 4th acquisition we are announcing, so in about a year. Look, we've been very opportunistic about this. We are not necessarily out there looking, but when interesting opportunities come to us, we will definitely take a close look. Ultimately, we want to create the platform for autonomous robots among people, and we would take whatever direction that the market ultimately leads us to. And doing an acquisition right now made a lot of sense. In other cases, we may just partner with folks and provide the platform to them. So we'll just do what makes sense.
Shifting gears, Ali, a big theme this year at CES, as you know, it was robotics, right? NVIDIA's Jensen Huang, he was on stage here. Mention your company. Let's take a listen.
That one delivers food to your house. That's connected to Uber Eats, and that's Surf Robot. I love those guys.
That's a nice compliment to get. from NVIDIA's Jensen Huang there, Ali. I'm sure you appreciated that. A big theme there that NVIDIA's driving at, Jensen Huang's driving at, is this belief, Ali, that like physical AI, it could really revolutionize, upend, redefining manufacturing, redefine logistics. Do you share that optimism?
Oh, absolutely. I think we are at the edge of another industrial revolution, scale of impact, because we are bringing machines that are not only capable of doing things at scale and with a lot more kind of productivity, but they can now do those things with their own intelligence. Right now, machines need a human attached to them all the time, and we are able to kind of remove that requirement. Therefore, machines can help us even more. I think it's an incredibly exciting time. By the way, on that photo you just shared or video you just shared, Moxie, the diligent robot, is just a couple of robots away from our robot. So there was a good omen from that happening.
I thought the robot stole the show, Ali, to be honest. Let me ask you this. Obviously, there's a lot of folks who are excited about robotics in the future right there. You've got a lot of competition. It's big tech is involved. Startups are involved. What makes Ali, your company different? What sets us apart? What's the competitive advantage? Is it the data? Is it the partnership? Walk me through it.
Yeah, look, at the end of the day, I think what you need to look at is what are the companies that are commercially deployed, because you learn so much from being out there in the real world. You learn insights, you collect the data that then feeds your models. But there are two types of models: the models in the institutional kind of knowledge of the company, and the models in the cloud where you're creating AI. So all those models are getting improved rapidly the more information, the more data you have by actually being out in the real world. So that's been our advantage. We are one of the largest autonomous fleets in cities already, and now we are going to have robots that are indoors, one of the largest, again, in hospital deployments. They can navigate really complex indoor places, and they can manipulate the environment. They have an arm, they can go through elevators, they can open doors. All that stuff is super important when you're bringing robots indoors, and now we have a commercial scale fleet that's teaching us how to do that even better.
Ali, as always, great to have you on the show. Thank you.
Thanks for having me.
Stick around. We bring you the biggest takeaways from today's market action. That's coming up next. Stock sink on rising trade war tensions, and Yahoo Finance's Jared Blikre joining me now with the trade day takeaways. Jared.
Thank you, Josh. It was risk off today, and there's really no getting around that. So let's take a look at some of the charts. Start with the Dow here. That was down 870 points, or 1 3/4%. You can see closed by the lows. And on some of these days, you just sink and you really just crash into the close. So I guess my point there is could have been worse. Nasdaq down 2.4%. A lot of the mega caps, which have not been doing well recently, they really didn't do well today. And the S&P 500 just a little bit worse off there. Again, really closing down close to those lows of the day. And even the Russell 2000, which was a bastion of strength, we were talking about the small and the mid caps last week, were green. Meanwhile, the big ones, the majors, they were red. Well, that was down 1.2% as well. And if we look at the sector action, just want to show you real quick here that Staples was the only thing in the green today. And we had a warning last week. Remember, the sector setup was very defensive. Staples had their biggest 5-day surge at one point.
That was a yellow flag. Right
yeah, since 2020. So let me show you. I cooked up some stats here. This has to do with what the VIX is doing. The VIX jumped about 4 or 5 points today, and I looked at what happens with the S&P 500 after you get a jump like that when the VIX has been quiet for a month. And so 1 week later, up about 0.3%. You can see the win percentage, 58%, not that great, but you get a month out, 2.4%, 92%, 3 months out, 5% and 75%, and then 1 year, 15% and 82%. Those are some really good odds. Again, this is a win percentage right here, percent positive, and this is a return right here. So historically speaking, this is usually a decent setup over the long term, just not over the very short term. But there were two outliers. One of them with 2007, the lead up to the global financial crisis, and the other was 2021, the lead up to the 2022 bear market. So could be the start of something bigger, but history says we're still on the bull side right now.
What would be, in your opinion, the big theme you're watching?
I gotta say, it's Sell America. And today was really about the bond market. And for that matter, that's what the Trump 2.0 presidency has been about. So let's take a look at what was happening in US Treasuries today. And this kind of started overseas. A lot of people are gonna point to Greenland and some Danish funds selling United States Treasuries. I gotta tell you what's happening in Japan right now. The vigilantes are in control. They are in revolt. The 30-year in Japan jumped 26 basis points today. We haven't seen anything like that in the US since 2020. So here's the 30-year. Ours was only up 8 basis points to 4.92%. But I want to show you the 3-year chart here because this is very important. Anytime that we have snuck above or very close to 5%, there's once, twice, and this happened a few times over here, we got a rollover in stocks. And it wasn't necessarily for the long term, but it did cause some problems. And what you're going to notice is over here and right here, we did kind of see a fast, rapid decline in yields to lower levels, and that supported stocks. But what's happening right now, you can see that we can draw a trend line here. It looks like this thing is forming a long-term pennant and wants to break out. Doesn't mean that we're going to break out imminently. We could still consolidate for a while, but long-term, there's a very strong likelihood that we break up through that. Now, longer-term yields above 5% have huge implications for the Federal Reserve, monetary policy, and I don't think we have time to get into all the ramifications here, but remember what Stephen Myron said back in his confirmation hearing. He was talking about the third Fed mandate. Yes, there are 3, moderate long-term interest rates. I think we're going to hear more of that.
What about crypto? Let's
do that real quick here because Bitcoin, risk includes Bitcoin, C number 1. So Bitcoin was behaving like a risk asset. As far as the safety trade, it was not doing it. And let's take a look at what Bitcoin was doing. It's sitting below 90,000 once again. This is a 3-year chart. And so one of the things you're going to notice here, broke the long-term trend line. This is nothing new. But what I do want to show you is that we were looking at a short-term uptrend and it was very narrow, but we are now in danger of breaking that 90,000, kind of my line in the sand for that. So it looks like Bitcoin it might be drifting into a short-term downtrend. And of course, the long-term trend here is also down.
All right, thank you, buddy. Appreciate it. Stick around. Much more Ask for a Trend still to come. Bilt, the credit card that gives you rewards for paying your rent, is now offering the same benefit to mortgage holders starting February 7th. They're also introducing 3 new credit cards that cap interest rates at 10% for 1 year. This comes after President Trump floated the idea of the lower rate. The company's founder and CEO joined Yahoo Finance's Opening Bid Unfiltered podcast to discuss the new program, housing affordability, and more.
Bilt today, we started 3 years ago when we met with this idea that rent is your biggest expense. Why can't you get rewarded on rental payments? Today, Bilt has grown into the largest membership for where you live. So today, we're rewarding you on your housing payments. We're running how you sign your leases, manage your home, and everything around your home. So I think the big realization we've had over the last 3 years was when we started with rewards on rent, all of a sudden we became the center, the anchor point of your home. Right? You would come to your Bilt app to handle your maintenance requests, pay your rent, book your amenity spaces at your apartment building. All of that was done through Bilt. And then we realized that your home doesn't really stop at the front door, right? And everything around your home, from your restaurant reservations, your gym booking, your car that you take to and from the airport, everything kind of anchors around the home. And we thought, when you're at a hotel, you have a concierge downstairs who can help you with everything in the city you're visiting. Why is your home not the anchor point for all of your commerce in your neighborhood? And so we've started expanding Bilt over the last 3 years to become the connection point between people who live in the neighborhood and all the businesses in the neighborhood. And today we have over 45,000 merchants that connect to people in their homes. We've driven over $10 billion of spend to local businesses through our platform. And our members now get rewarded on their rent payments, but also get special benefits when they're dining at local restaurants and visiting their local fitness class, all through Bilt. You also must have a very unique take on affordability in this country. Like, how do you see things? Look, I think this is you may know some of this, but my parents were immigrants to this country. My dad grew up in a fairly poor village on the outskirts of Delhi in India. And like the story you hear often in Silicon Valley, he came here with no money and worked his way up through the American dream. And that was possible, by the way, in our parents' generation. And that's what made this country great, right? And I think today it's become harder. And what's happening is you have this growing wealth gap where it's not the bottom that's getting screwed the most. There's always been challenges at the bottom. And we have so many ways that we are working to solve them as a government, at city level, at state level. It's the middle that's getting squeezed. I mean, you see this coming out of COVID. Inflation has hit the middle the hardest because you have less exposure to equities. Your salary isn't growing up at the same level of inflation. Hourly jobs tend to have corrected faster, and yet your housing prices, your healthcare prices, all of these have just skyrocketed, right? And so the question is, one, obviously, how do you bring down prices? But more importantly, how do you help people make more income?
Yeah.
And how do you give them more for every dollar they spend?
Because prices aren't coming down.
No, they're not.
They don't come down.
I don't buy that. Obviously, there are people in New York City who disagree with me on that. But like, I think there is an opportunity, especially the one counteracting force to all of this is AI. And the amount of productivity that we can generate per individual now in this country with new AI technologies is substantial. And so when people are so worried about jobs going away, and I have a different view, which is this might be the only way that we can increase income on a per individual basis. Because if all of a sudden, same companies can generate more output, you're not hiring less people. You're just creating more output.
Yeah. Are you seeing within, golly knows how much data you get, but are people, how are they doing with their rent payments?
Rent payments
right now.
Historically rental payments have retained, it's your top of your payment stack. I mean, it's your home.
Yeah.
And so you today are still seeing rent payments continue to be made on time, even during COVID, which was the worst possible time for people collecting rent on that side and people having to pay rent. You still saw 85-90% on-time payment rates. And so we see that the big thing that is promising is rental prices are stabilizing. And so while for the last couple of years you've been seeing them go up consistently, you're now seeing stabilization and you're seeing property owners start to give incentives and concessions again. And a lot of that, by the way, is not even driven by less demand from people moving into cities. It's that people are actually staying home with their parents, people are living with roommates.
Yeah.
And by the way, it's a real thing. Like you spend 1 year at home with your parents.
I mean, that's massive money.
$30,000 in savings.
I couldn't live with my parents. I could just thinking about living with my parents right now. It's freaking me out, dude. Like, thanks for bringing that up. But like, is that, if you're under 30 right now, is it realistic that you will own a home?
Short answer is, at this very second, home prices are still too high.
Right.
But that doesn't mean that there's not a path for the first time for this audience to buy a home. Mm-hmm. And I think one of the things that we have been working on at Built is, as part of this membership for where you live, you're earning rewards on rental payments, you're building your credit history, and you're actually building a path to home ownership. And so when we look at this today, there's a few different challenges with home ownership. One of them is just honestly transparency. It is so hard to understand how much a home costs and what you can afford.
Yeah.
Like
you're just buried in digital paperwork.
It's digital paperwork, but like, think about this. You spend your whole rental life going from, my rental cost is $2,000 a month in rent. And then they say, you want to buy a home? It's $500,000. And you go, whoa. How does that math that up? And like, I'm a Wharton guy, and it took me a long time to understand the different loan options and how much you put down and your interest rates and what that means. And it's just so complicated. And so number one is actually just simplifying and creating transparency. So one of the things that we worked with Fannie, Freddie, and FHA on was, can you just tell somebody, for this much that you're paying in rent, here are the homes that you can afford to buy today, all in.
Sounds like
my
a
mortgage payments,
great.
My principal, my interest, my insurance costs, my HOA costs, taxes, just put it all together for me and show me homes so that I can compare. And then let me decide how much of savings do I want to put up front and show me the different options. Because like most people don't realize, there are programs like first-time home buyer programs where you can put 3% down. That's far more affordable than having to come up with 20% down.
Wait, really? 3%? I gotta make a note. That's pretty good.
And that's the thing, Fannie Mae, Freddie Mac, these programs exist, but nobody knows about them. Mm-hmm. And it's also hard to know the trade-offs. Like there are trade-offs to what's better for you. So just making it simple and saying, hey, every year when you're looking for your apartment renewal, here are your options to renew your apartment. And by the way, here are rewards you can get if you sign a lease at one of these apartment buildings. Or hey, you're ready to buy a home. Here are the homes you can afford. And here's how that same $2,000 a month compares in home ownership in New York versus Washington, D.C. versus Dallas versus Chicago. And it's all in, because what you don't realize is the same $500,000 home in Chicago can cost you double the price as it may in Dallas.
Yeah.
Because you've got city taxes, state taxes, insurance
Everybody wants a
requirements.
piece.
And so it's just so confusing and complicated. And none of that should be the case. I mean, that's part of this idea of a membership with Built. We just take care of everything for you in and around your home.
That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet.